If you are holding shares of Singapore Airlines or SIA, you almost certainly saw the headline that likely made your heart skip a beat. Net profit collapsed by a staggering 67.8%. That is a drop of nearly two-thirds in bottom line earnings. When a blue chip company, a national icon, reports a profit drop of that magnitude, the knee-jerk reaction is almost always panic. You might be looking at your CDP statement right now, wondering if the post-pandemic party is officially over and if you should sell before the stock crashes back to 2020 levels. But if you strip away the scary headlines and the one-off accounting treatments, the real decline is actually a very different story. In fact, the core business, the business of actually flying planes and selling tickets, didn't collapse at all. Operating profit actually rose, albeit marginally. The real story here isn't about planes. It is about a specific $417 million hole caused by a strategic bet in India. This is a much more complex situation than a simple sell signal. And misreading this report could cost you significant dividend income. I am Iggy, your Singapore-based market analyst, and my job is to cut through the noise of sensationalist headlines and show you what really matters for your CPF, SRS, and SGX portfolios. We do not care about the hype. We care about the fundamentals that drive long-term value. And we have been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide-by-slide analysis through Singapore Airlines' latest half-year financial report. Let us begin the methodical breakdown. We are going to look at this report as a tale of two airlines. On one side, you have the operational fortress, and on the other, you have the bottom line disaster. We need to understand both to make a decision. First, let's look at the top line, the revenue. If you only looked at this metric, you would think SIA is an absolute champion. The group reported a record half-year revenue of 9,675 million Singapore dollars. That is up 1.9% year-on-year. Now, why does this matter? It tells us that demand is not falling off a cliff. In fact, traffic is booming. The group carried 20.8 million passengers, which is an 8% increase. This brings us to a critical metric for airline investors, load factor. Think of load factor like the occupancy rate of a REIT. It measures how full the planes are. SIA reported that load factors jumped 1.3 percentage points to a very healthy 87.7%. For context, in the airline industry, anything above 80% is generally considered strong. Hitting nearly 88% means their assets are being utilized incredibly efficiently. The planes are full. Because the planes are full, the core business is actually stable. Operating profit, this is the money made from the actual operations of flying, fueling, and servicing aircraft. Before we look at investments or taxes, rose marginally by 0.9% to $803 million. So, if the shop is busy, the planes are full, and revenue is at a record high, why did the net profit collapse by nearly 70% to just $239 million? This brings us to the second part of our breakdown, the $417 million anchor. The collapse in net profit is almost entirely due to what is called share of results of associated companies. This line item on the balance sheet was $417 million lower year-on-year. The culprit here is clear: Air India. SIA owns a 25.1% stake in the Air India group. This was a strategic move. The idea was to tap into the massive, booming Indian aviation market. It is a high-growth play. But right now, that growth is coming at a massive cost. SIA began what we call equity accounting for Air India's performance starting in December 2024. For those of you new to financial statements, equity accounting means that SIA cannot just ignore what happens at Air India. Because they own a significant chunk of the company, they have to take 25% of Air India's profits, or in this case, 25% of their losses, and recognize it directly on their own books. It is like owning a hawker stall that has a massive queue every day. That is SIA's core business. But the owner is also paying off a massive debt for a second failed stall he bought next door. The main business is fine, but the side investment is dragging down the whole family's net worth. Investing in Air India is like buying a fixer-upper landed property in a prime district like District 9 or 10. The location, India, is incredible and the long-term capital appreciation potential is huge. But right now, the renovation costs are bleeding SIA dry. The financial report explicitly states that SIA is committed to supporting Air India's comprehensive multi-year transformation program. When a company uses the phrase multi-year, that is corporate code for expect these losses to continue for a long time. This is the anchor we need to watch. Now, let's move to the third section of our breakdown, and this is the one that matters most for dividend investors, the income angle. Despite the profit crash, SIA is aggressively returning cash to shareholders. This is somewhat surprising given the headline numbers, so let's break down exactly what you are getting. They declared an interim dividend of 5 cents per share. On top of that, they declared an interim special dividend of 3 cents per share. Both of these will be paid on the 23rd of December 2025. But here is the forward-looking plan that is really interesting. SIA has announced a plan to pay a 10-cent special dividend annually for the next 3 financial years, subject to AGM approval. Let's do the math on the yield. If we assume a share price of roughly $6.64, the total interim payout of 8 cents gives you about a 1.2% yield just for the half year. However, if we annualize this, assuming the final dividend matches the interim, plus we factor in those locked-in special dividends, you are looking at a total forward yield of roughly 5.9%. For a Singaporean investor, a 5.9% yield is attractive. It beats the CPF ordinary account rate of 2.5% significantly. It also offers a healthy spread over the latest Singapore T-bill cut-off yields. However, I have to give you an Iggy warning here regarding capital recycling. We need to ask, is SIA generating excess cash to pay this, or are they just giving you your own money back? We noticed that cash and bank balances declined by $1.8 billion to $6.4 billion in the first half. Management noted this was partly due to paying out previous dividends and repaying debt. While the yield is real, it is not risk-free. You are effectively getting paid a high yield to hold a stock that has significant execution risk in India. You are being compensated for the turbulence. Moving on to section 4. Beneath the wing, we need to look at the operational metrics beyond just revenue. Even within the profitable core business, there are warning signs that we cannot ignore. First, pricing power is weakening. Passenger yields fell 2.9% to 9.9 cents per passenger kilometer. What does this mean? It means SIA is making less money for every kilometer you fly. Why? Because competition is back. Other airlines have restored capacity and they are fighting for market share, forcing SIA to lower ticket prices to keep those planes full. Second, inflation is biting hard. Non-fuel expenditure surged 5.9%, costing an additional $353 million. Inflation is hitting everything from staff costs to airport fees to catering, and this is sticky inflation. It doesn't go away easily. Third, we have a fuel hedging misfire. Usually when oil prices drop, airlines cheer. Fuel prices did drop 12.7%. However, SIA didn't capture all the savings because they hedge or lock in their fuel prices in advance. They swung from a fuel hedging gain last year to a loss this year. This is the double-edged sword of hedging. It protects you when prices rise, but hurts you when prices fall. Finally, cargo is soft. Cargo revenue fell 2.8% and yields dropped 4.1%. During the pandemic, cargo was the golden goose that kept SIA alive. That gold rush is officially over. We are back to normal cyclical cargo dynamics. Let's wrap up the breakdown with the balance sheet and outlook. The balance sheet remains a fortress, but the walls are slightly lower than before. The good news is deleveraging. Total debt fell by $2 billion, improving the debt-equity ratio to a very healthy 0.7 times. For an airline, which is a capital-intensive business, 0.7 is a very conservative and safe number. However, there is a specific date you must mark on your calendar. November 24, 2025. There are convertible bonds exercisable until this date. $714 million worth have already been converted. When bonds convert to shares, it dilutes existing shareholders, meaning your slice of the pie gets smaller. There is still $136 million outstanding. It is a small overhang, but one to be aware of. Looking ahead, management expects demand to remain resilient for the year-end peak. However, they explicitly flag geopolitical tensions, macroeconomic headwinds, and inflationary cost pressures as ongoing challenges. That is management speak for the easy money has been made. So, how do we synthesize all this data? Here is Iggy's assessment. First, let's look at what is working. The core brand is strong. People still want to fly SIA. The load factor of nearly 88% proves that the product is premium and in demand. The balance sheet is clean with low leverage, meaning they can weather a storm. And finally, that special dividend plan shows a management team committed to rewarding shareholders even during a transition period. Now, what is not working? The Air India investment is a massive drag. A $400 million swing in associate earnings is not a rounding error, it is a hole in the boat. Furthermore, yields are compressing. The days of charging sky-high prices because there were no other flights are over. SIA is now in a dogfight for passengers. So what about the valuation? At a projected yield of 5.9% and a price to book that has moderated, SIA is neither dirt cheap nor expensive. It is fairly valued for a company in transition. This leads us to the final recommendation. For existing unit holders, my view is to hold. The yield is decent. If you have held this long, selling now on a headline, panic would be a mistake. Treat the upcoming December dividend and the special dividends as an income play for your SRS or CPF portfolio. The company is not going bankrupt. It is just digesting a large acquisition. However, for new buyers looking to enter, my advice is to wait. The risk-reward isn't quite there at $6.64. I would not chase this yield. The risk of further losses from Air India is real. If Air India requires another massive cash injection, like a rights issue, that dividend yield will vanish instantly and the share price will punish you. The specific signal to watch is not passenger numbers in the next quarter. Ignore that. Look specifically at the line item. Share of results of associated companies. If the loss narrows to less than $200 million, that is a buy signal. It means the turnaround is working. But if that loss widens to over $450 million, that is a sell signal. It means the anchor is getting heavier and it might sink the ship. We have covered a lot of ground today, stripping back the scary headlines to look at the actual mechanics of the SIA group. It is a story of a strong core business carrying a heavy backpack called Air India. If you found this deep dive valuable and want to protect your portfolio from headline noise, consider becoming a free or paid subscriber to our Substack. You will be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We are also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, keep your emotions in check, and I'll see you in the next analysis.